Corporate debt levels are rising to record levels and beginning to spook investors. So is a major crisis ahead? Our Mike Santoli is live at the NYSE with more on that. Hey, Mike.
Hi, Melissa. I think it's certainly too soon to say a major crisis is ahead, but you can understand why there's anxiety building up around corporate debt levels and also the behavior of the corporate bond market. The level of corporate debt right now as a ratio to GDP is pretty much as high as it's ever been. And those previous peaks that you might see on the chart at about 45% of GDP are pretty much coinciding with peaks before we had recessions. And now you have the possibility that the corporate market's going to become less generous, right? You have spreads going up, investors demanding higher yields to take on the risk of especially lower investment grade debt, like BBB rated. That has gone up a lot recently. That's where GE debt is. Of course, a lot of the anxiety is surrounding GE and the possibility of those bonds being downgraded. But I do think you have to step back and take a longer term perspective on exactly where we are in terms of spreads. If you look way back toward the year 2000, you can barely see this increase in spreads. It seems like it's pretty premature to think that it's something that the markets can't handle at this point, especially when you consider a very tiny percentage of corporate debt is coming due in the next year or so. It's really 2 to 3 years out that you would have kind of that reckoning. Can they refinance? Can they pay off the debt? So to me, it's one headwind for valuations. It shows you stockholders are definitely gravitating toward companies with less debt because they're worried about this. But right now, it just seems like one more pinch to margins and maybe a little bit of a winnowing of winners and losers versus any kind of a crisis that would spill into the real economy, guys.
2 more years away for when the debt reckoning happens. That seems to coincide with when most people are calling for a recession. If they are calling for a recession, they're saying 2020. That's not good timing.
Well, exactly, Melissa. And by the way, recession is when this really starts to hit. The cash flows right now without a recession seem like they're sufficient to service this debt level.
All right, Mike, thanks. Mike Santoli at the New York Stock Exchange. Should we be worried?
Well, too, high yields at 29-month lows. It's getting mauled. I was talking to a trader before the show. Basically, his quote was, "It's getting mauled." So the bottom line is the key is, really, it's about the credits, though. So high yield you can understand in this environment. There's some corporates that borrowed a lot of debt, and that number in terms of corporate debt to either to GDP, et cetera, a lot of these guys did it at zero rates, and they did it because of zero rates. And I don't know that that's as big of a burden as that number might show.
All right, for more on this, let's bring in Larry McDonald, the founder of the Bear Traps Report and a CNBC contributor. So with market rumors swirling, we thought this would be the perfect time to play a little fact or fiction, debt crisis style.
Games with Larry.
Nice. And since Guy is here, I'm going to explain the rules, even though it's a very straightforward game. I will give a statement. Larry will tell us if it is fact or fiction. Ready? We will play this game now. All right, first up, a corporate debt crisis is coming. Larry, is this fact or fiction?
Fact, but the Fed, with a little softening, can put it off for another 6 months. But fact, we're in the throes of one now.
So what are you saying? I mean, why do you say that we are in the throes of one right now? And what does that portend in terms of the market?
Well, you're starting to see for the first time in a long time, deals get hung on the loan level. So leveraged loans, which that's typically the highest part of the capital structure. You shouldn't see deals getting hung. And I've talked to a couple of bankers in the last week. So you're getting hung deals there. That's reminiscent of about 2007. But the supply of loans and the amount of deals is nowhere near that level, so I don't want to say it's like 2007.
Right.
But that's your first warning sign. And then the price discovery on investment-grade bonds, that price discovery relative to loans is spectacular. In other words, we're seeing real price discovery in investment-grade bonds, but the loans haven't really marked down as much yet. So that means you're in probably the first, second innings of a big problem.
You just said we are in the throes.
Yeah.
In the throes of what?
Investment grade credit crisis. I mean,
we're in a credit crisis now.
An investment grade, like you're looking at real carnage, especially like Europe today. Barclays, European banks, from a global perspective, we're not at 2007 levels, but we're in the throes of like the worst credit crisis we've had since 2011.
Do you think this is liquidity? In other words, they're one and the same. Often liquidity dries up as credit deteriorates. But I mean, I realize that Italian bonds are blowing out. I realize that there's some sovereign issues here and there. But AAA credit is blowing out.
Blowing out globally. But once again, the Fed, what we saw in 2015 and 16, they promised us 8 rate hikes. They only delivered 2. And whenever we've seen this type of, this is really the beast in the market is trying to break the Fed over its knee. And in the past, the Fed has pushed that policy path a little bit off, and that's softened things.
Let's talk a little bit more about the next statement, which has to do with the Fed. The Fed is to blame. You mentioned the Fed already. Is this fact or fiction?
Guy, don't answer this question.
I didn't say she's looking at Larry. She's not looking at me.
I don't like to look at Guy when I'm having, when there's a guest on set.
Period.
Yeah, period. But Larry, fact or fiction? The Fed
any fact, but Fed, ECB, Bank of Japan, Bank
Central
of England.
banks in general.
You just kept interest rates too low for too long. People reached into investment grade bonds. Deals were done that shouldn't have been done, and now we have a 25% move lower in oil in 5 weeks, and all of a sudden it's real selling.
Last year, are dividends safe? Fact or fiction?
They're in certain sectors, consumer staples. We love the staples here. They're safe. In the energy space, you're seeing real selling in the equities because the dividends are not safe. But this is spectacular because think about it. You've got all this money in terms of passive asset management on the equity side that everybody's been talking about, $1 trillion coming out of FANGs. And then investment grade bonds, investment grade on the triple B. So that triple B bucket is 2.5 trillion. 2.5 trillion of triple Bs. The high yield market as a whole is only 1.4 trillion. So that's a massive crossover. So that means that the dividends in the S&P, because of all that leverage, are not as safe as they were in previous cycles. So I think you could have probably a 20 to 30% bounce from here in the staples as people really look for those safest dividends within the S&P.
Are the safe dividends, when you look at technology, though, does that count as safe dividend? When you look at the balance sheet, they've got virtually, in many cases, no debt.
Yeah.
All this cash. So they're pretty safe, wouldn't you say, as well, or no?
Well, there are some dividends payers.
Right.
The
Microsofts.
Microsoft, Intel, those are pretty safe dividends.
Okay.
Yeah. But I just think that if you look at 1999-2000, that move, when that rotation out of tech, you're talking about $1 trillion that has to go somewhere. It's going to move into value, into staples. And in 1999-2000, staples were up 30% in 6 months.
Mm-hmm. Larry, thank you. Larry McDonald,
Thanks very much.
Traps Report, and a CNBC contributor. I was talking to Peter Bookvar, another CNBC contributor today. The book. And he was saying that 40% of Russell 2000 debt is floating rate debt, which means obviously that the rates get ratcheted up every single time the Fed raises interest rates. Yeah. And it's just going to float along with the markets. I mean, that's kind of a lot of exposure.
And look at the IWM underperforming. So again, high yield, small cap, these are the things most exposed in a credit crisis.
Yeah, I would just make one point. Larry just said the Fed will be responsible when we get to this next point. Same thing happened in the late 90s. Same thing happened in the lead up to 2007. And when you think about it, everybody could put their finger on what the thing was that was going to make our economy go into a recession and subsequently have the S&P 500 drop 50% in each time. Larry's putting his finger on it right now. The problem you had back then is the eventuality engaging that, right? No one could actually figure out.
Do we blame the Fed or blame the investors, though? I mean, the bottom line is people
but what I'm saying is,
stuff.
well, the Fed kept interest rates too long.
You can't blame the Fed for buying something if you're an institutional investor and you bought debt that was too expensive.
Tim, but what we're saying is too low for too long. In each of those instances, the Fed was able to get Fed funds rate back to 6% in 2000 and 5% in 2007. They can't even get above 2% right now without causing a spasm in the market.
We would like to see 3% Fed funds so we can go back down to 1.5%. That's where we are.